Hey everyone, welcome to the KE Report, the Daily Editorial on Tuesday, September 12th, chatting with Jim Tassoni. Jim is the CEO of Armor Wealth Strategies. We chat with Jim every month as more of an active trader. He's a momentum trader. So, in terms of momentum in these markets or in a wide range of sectors, it does seem like everything just continues to melt higher. Jim, you actually made the comment when we were talking off mic that this kind of feels like a buy anything market and it's just going to move higher. I know that can give some people an uneasy feeling, maybe feel like we're in some sort of a bubble or some sort of topping pattern. But fact of the matter is, I think that's been the case for months now. So, Jim, what do you think when, again, you even made the comment, this is a buy anything market, you're going to do well with it. What do you take away from that as a trader?
Yeah, and thanks for having me again, Corey. And it's such an interesting market since Liberation Day and this melt up we've experienced. And obviously there's been better places to be than others, but it's pretty hard to be a bad investor in in this environment. I mean, you can pretty much throw a dart at the board, and even if your analysis is flawed, the market's bailing you out. So it's one of those markets where it's been pretty easy to make money for the past few months, but I will never get complacent in these markets because as soon as you do that, the rug pull is probably coming.
Well, Jim, because you look at things through the lens of momentum, when you look at things like, let's just start with the general equity markets. When you look at the S&P, when you look at the NASDAQ, they just made new all-time highs just yesterday, and they're doing the same thing last week. Is there a point or something that you look for technically where you think that maybe there's some buying exhaustion and that's where you ring the register, or how are you looking at the general equity markets?
Yeah, I think the best way to sort of play markets like this is to have that core allocation, which we continue to have. We've been long the Qs, we've been long, SPY since early May, and that's been a great trade. But I think when you get up into levels like this, I don't think it hurts to be a little bit tactical and have sort of, your levels, whatever your strategy is. For me, I have volatility based risk ranges. And so it gives me the ability to shave some at the top, buy when it comes down to the bottom of those risk levels. And I mean, these are smaller increments, so all trading around and nibbling around a core position. But by being able to do that, it allows me to A, stay long until what I believe to be the trend is broken. And I have trend levels, as we talked about last time, that are stepping up with each progressive move higher that keeps me long in my core position. But having those shorter term risk ranges, whether or not it's the greatest trades that I'm making, psychologically taking some off the table, booking profits at various points along the way in smaller increments allows me to have that feeling of comfort or safety, I guess isn't the greatest word to use, but it at least gives me less heartburn when we just keep ascending higher and higher every day.
Jim, what about trading around certain news events? This week we have the Fed meeting coming up. I know that the president, Trump, has been able to move markets. That's hard to trade around because we don't know who he's going to go after next. But these news events or even data events, when we get inflation data or jobs numbers, do you trade around those?
Yeah, I do to an extent. What I really try to do on any news event, again, with sort of the tactical efforts, is to use those news events or spikes or dips in various markets, as long as they don't break my, what I'll call my intermediate trend. I like to use those opportunities to either sell a piece and or add to my position if I think, hey, this is some news. It brought one of my holdings down to a level that I'd like to add here because we're still holding above trend. I'm still bullish, or vice versa. I'm still bearish on this position. It popped up and now I want to add to my short. But I'm confident doing that because I do have those levels where I say, okay, if it breaks this level, if it goes above it on my shorts, if it goes below it on my longs, I know I'm getting out. And that gives me the confidence to continue to trade in these markets because I have those disciplined points where I can say, okay, now the trade's been invalidated. And now I know that my thesis, whether fundamental, technical, or a mixture of both, has been invalidated.
Well, Jim, one data point people are watching very closely is the first cuts in about 9 months from the Fed. Whether it's 25 or 50 basis points, I think the bigger message is that people are expecting a series of cuts now. And so, with that being said, are there any interest rate sectors that you feel will benefit more than others based on the lowering of rates?
Yeah, we continue to see sort of this market. I guess I would call it almost like a inflating market with a real administrative push by the Trump administration to grow our way out of this debt burden that we see here in the United States. So we want to continue to be invested in asset classes and areas that benefit both from growth, but also from inflation remaining what we believe to be at slightly elevated levels. Our forecasts are actually for a much higher than consensus growth with slightly higher than consensus inflation. So in a market like that, we continue to like, and I know it's been, we've done really well on a lot of these, but we still love commodities. We still love the commodity markets. We like a lot of the growthier type sectors and different ETFs. So we continue to like things like the Qs. We've gotten involved in some smaller ETFs like quantum technology and the space ETF, UFO, we've been in. We've also been broadening our exposure a little bit. We've actually swapped into the RSP ETF away from the SPY because we do want to broaden our exposure while we're taking some more targeted opportunities in some of these higher growth names because we continue to think growth will do well heading into the next at least 4 to 6 months. We want to broaden out our themes. So I don't know if hedging is the right word, but we're broadening things with an exposure to RSP, which is the equal weight S&P as opposed to the cap weight.
Interesting. Okay, this is sounding very kind of bullish, to be honest with you, especially going into those growth names. Now, are there any sectors that have just started to move, or let's say haven't been moving for 6 to 12 months? Because I feel like a lot of sectors are in uptrends, but anything that is just starting to come onto your radar in terms of a positive trend where it hasn't been there for the last little while?
Yeah, one area that we're looking at that definitely has not been one that has participated to the extent that a lot of other areas have is healthcare. That is one sector that we are starting to become more constructive on. We think that this is a potential area that could play some catch up, even though it has more defensive characteristics, and we tend to lean more towards the growth side of things right now. We have actually recently taken a position in the healthcare sector, and we think this could be poised for at least a short to intermediate health or catch up trade.
Well, Jim, you also mentioned the commodities, and a lot of commodities have been running higher, but there is a laggard sector there too, and that's the energy space. When you look at oil and nat gas, they haven't had the same kind of pizzazz that, let's say, gold or silver or platinum or copper have had, but they have had a little lift recently. How are you looking at something like oil and nat gas?
Yeah, right now we have no position in oil, no position in nat gas. We're kind of on the sidelines there because again, the trend is not as clear to us, and with limited capital to allocate, we've just been finding better places to put our cash. We do have an allocation to the financial sector via the XLF, which has not been the most phenomenal trade in our book. I'll be the first one to admit that, but we do want some exposure to that sector. We still think that there's some upside opportunity for that. The XLF continues to hold above our bullish trend level, not by much, not like some of these other names, but that's pretty much our only exposure to the energy sector at this point.
So, Jim, what commodities are you seeing as the best performers? We talk a lot about precious metals. Gold and silver just had a breakout. We also cover copper, and copper did break out, but then it crashed pretty quickly after the tariff news was clarified. But now it's been grinding higher, still a little ways off from that breakout spike level. All kinds of other commodities to talk about. Uranium's been doing pretty well. What commodities in particular have your attention then?
Yeah, so we're long mainly via ETFs, a large basket of commodities, and that includes kind of your usual suspects. We're long gold, we're long silver, we're long the gold miners via GDX. We're even playing platinum, we're long the steel ETF. Those are all different areas of the commodity market, mainly, as you can tell, metals and miners that we think are showing just phenomenal continued momentum and continued upside moves. And so along the way, we don't mind trimming these positions. We'll add them on pullbacks, but when you've got a trend like this, lower left to upper right, these are the markets as a more momentum-based, growth-based trader that you've got to be involved in. And so, fortunately, a lot of these markets we've been involved in some way, shape, or form since, late last year, heading into this year, and they've been pretty phenomenal trades for us.
Jim, just to follow up on GDX, when you look at the gold equities, it's taken a while for them to get in gear considering how high the prices are. But last week, GDX finally broke above its 2011 peak. So when you see something like that, where something takes out a long-term price peak, the lateral price resistance, does that give you a sense that it's now in momentum, or are you worried that it may get retested right away?
Yeah, no, I mean we think that the momentum thrust continues to be to the upside, and we really like GDX here. Now, is it, at least according to the signals we look at, is it a bit overbought at this place? Absolutely. Is there opportunities for exhaustion? Absolutely. And so we actually would look, right now with it, I think I'm looking at my screen and it's trading at about 69.10. We've got sort of an upside, I would say, take a little bit, not sell the position, but you could trim, at this 69.75 level, to 69.95, somewhere in there. If we hit that, we'd probably take a small piece off and book some profits. Conversely, though, we're going to be long this thing. We think that there's room to stay long all the way down, and we've been long this since the mid 40s, so we've got some room to play on this thing, but all the way down to 68.30 area, as long as it stays above that and continues to trade higher, we're going to continue to ride this momentum.
Now, Jim, for something like GDX, considering it has pretty much doubled so far this year, and looking at how far it is separated from the moving averages, what's the trading strategy around here? I realize you still see it going higher, but would you be just waiting for a pullback, or do you simply just keep adding to your positions on a regular basis because of the longer term positive outlook you have?
Yeah, no, I'm definitely so I guess two different ways to approach this. If you're already in the position, I wouldn't add here. I probably honestly wouldn't add to this position until we saw, close to a 10% pullback at this level. 63 and a quarter would be the area that I would want to add. We break that level and I would be out of this trade for good, at least on the sidelines for now. And then conversely, on the upper end, like I said, I would be looking to manage this trade by booking profits at opportune opportunities. Right now, 69.75, just looking at my chart, would be an area that I would probably look to sell a piece of my current position. But if you're not in this trade, I think this might be a difficult place to enter. currently. I think I would probably, like I said, wait for a pullback to at least 68.35. That would be an area that I would consider adding a small position. I wouldn't put my full position on there. And then if you got, down to 63.25, which I realize is a long way from here, but 63.25, if we got down there, I would take, I would be much more willing to initiate a position or take a shot if I wasn't already long in this name.
Well, Jim, I also want to ask you about silver because for the longest time, silver was kind of stuck in a trading range, but it did finally break out and it's now in the 42 to $43 range. There's really not a lot of pricing resistance or memory between that level and the all-time high from 1980 and 2011 at the $50 range. So are you expecting that epic run to $50 to retest it? Are you expecting some other levels or pockets of resistance? How are you looking at silver?
Yeah, this is another one that's, broke out and we have been long for, I'm looking at when I entered this trade here. We've been long since early August on this one, and it's been a great trade for us in this market. This one was a little tougher to get off the ground than our gold or our gold miners trade, which have just sort of zoomed all year long with a small pullback here or there, but overall great trades. This is one that, I have a hard time, saying this is the top and I'm going to sell my whole position here because I know that we're going to correct from these levels. Have we run a long way? Yes. Are we technically overbought? Probably. But I would be more in the camp to, book profits at various levels as you move up and can hold that core position until we break momentum. And for me in the silver futures market, I'm going to stay long this market until we have a close below 38.17. So that's my level right now on the futures. As long as we're above that, I'm going to stay long in my core position and continue to ride this momentum because I've made too many mistakes in my career thinking I can be smart enough to call a top. I'd rather trail my stops and let the market take me out. It's allowed me to ride a lot more winners than I probably otherwise would have.
So, Jim, I think that's such a key point right here where, especially the precious metals, but a lot of markets have simply just separated and broken out so much that some of the lower targets that would turn people like you, and I think a lot of investors bearish, are a lot lower than where these markets are trading, right? That's just a fact of the matter. The thing is, everyone's always saying, ooh, we're due for a correction, which I feel like we definitely are, but you can miss out on a lot of upside momentum. And what we're seeing here is a wide range of markets just continue to move higher. It feels weird talking about the broad averages and the growth stocks, the tech stocks, all at all-time highs, but then also the precious metals stocks and precious metals also breaking out and separating from their moving averages. Have you seen this environment before? Just what kind of trading or investing world are we in here where it does seem like everything risk on and risk off are moving higher?
Yeah, and you make a phenomenal point there, Corey, because for me, I've always been a believer that you can expect a correction and eventually one is going to come, but if we get a 20% correction, but you miss out on 30% upside waiting for that 20% correction, are you really better off at the end of the day? And the obvious answer is no. So agree with you wholeheartedly there. Secondly, the only environment, and I was a very young investor, still in school, still doing internships back in the late 90s, early 2000s. That's the closest environment that I saw to this. And a lot of it's anecdotal because I wasn't as involved as heavily in the markets then as I am now. But it was a similar situation to, I opened an account back then and it was, well, what should I buy? And the advice you would get was, well, buy anything. Everything's going up. It's a bull market. Buy anything. And we know how that story ended. I don't necessarily know or think that everything is going to end the same way, that we're going to have a 85-90% drawdown in the NASDAQ like we did in the early 2000s. The thing I do know, though, and this is what allows me to sleep comfortably at night, is that I have a system that won't allow me to participate in those kind of drawdowns. I've done pretty well this year. My investors have done pretty well this year. And we know that we have our levels already set, that if we break these, we're going to move out of the way. And if the market continues to trend lower, we're not going to participate in that pain. And so my system's not perfect. It's never going to call the top. It's never going to get you out at the top, but it's going to book profits. It's going to book gains, and it's going to allow you to participate as markets are going up and protect a lot of your downside when the inevitable turn does come.
Okay, that makes sense. So essentially, ride the wave higher, but when you do get, I guess, some sort of a significant downturn, have a strategy around that and don't be afraid to get out. The problem is, every downturn's been a buying opportunity recently. So the big question is, when will one of these downtrends finally take hold for longer than really a few days from what we've seen over the last few months? Jim, we'll wrap it up here. Again, Jim Tassoni, CEO of Armor Wealth Strategies. Click that link in the show notes to visit the Armor Wealth Strategies website. Keep up to date with what Jim is trading. Jim, great chatting with you as always. Thanks for your time today.
Thanks, guys. Appreciate it.